Hey everybody, I'm Silvio Perez. I'm the head of product innovation here at Metadata. And in this presentation, we're going to be talking about how to build a paid media strategy in a down economy. Now, to get things started, I wanted to mention this quote from Sun Tzu, which is, "In the midst of chaos, there is also opportunity." So regardless of how bad things seem right now, always understand that there is an opportunity to be had. Now, for this presentation, the agenda that we have is, first, we're going to be talking about what is the mindset of top advertisers? What separates the top 1% of advertisers from the bottom 99%? And truly, and I really want to talk to the mindset because perception is reality, and how you're approaching your paid campaigns makes a massive difference on not only how you're going to execute, but also how you're going to judge success. Second, we're going to be talking about how to respond to budget cuts. This is going to vary by person who's watching this. Some of you have been affected in a very dramatic way. 50 to 70% budgets have been cut for you, in addition to layoffs and a whole bunch of other things. And then for some other folks, this probably is not even an issue. Maybe your budget hasn't been touched, or maybe you're just getting started for the first time and you're just establishing new budget for your initial campaigns. And then finally, we're going to talk about building your strategy and talking through some frameworks that you can leverage to really help you understand, based on your goals and your objectives, what should you be focusing on, and then some tactics to help fuel some ideas. So with that, if that sounds good, let's go ahead and jump right in. Now, let's talk about the mindset first. Mindset of top advertisers. When it comes to your paid experimentation, I want you to think like an investor and execute like a scientist. Now, here is what I mean. Let's dive a little bit deeper. Investors, they take calculated risks. They always look to diversify. They have stop loss measures in place. They don't react emotionally to fluctuations, and they view instability as an opportunity and not a threat. Very different than the mindset of most folks when they approach paid experimentation. They're not taking calculated risks. They're just going in, they hear about this new latest trend, and then they throw some budget behind it, and then they wonder why it doesn't work after 15 days. They aren't looking to diversify. They have too much media spend into certain channels. They're not looking to expand their impact across different channels. And because of that, they have a very big risk. If any one channel, any one tactic goes down, now their entire paid media performance is in the toilet. They don't have stop loss measures in place. They're letting their ads spend way too much. You're not using things like auto pause rules to allow you to pause your ads based on certain performance threshold. You're letting your ads just keep running. You keep giving it more budget, and you're not giving it the attention it needs to make sure that you're reducing that inefficient spend. And then this last one here, they don't react emotionally to fluctuations. Most advertisers, we are human beings and we're emotional creatures, and we do react emotionally to fluctuations. One week, let's say our cost per lead is really good, and then the next it's really bad. And because we're not looking at our impact to revenue and our cost per lead spiked, we go ahead and turn that off. Or at the very minimum, we don't understand what our real break-even cost per lead is, and we're just using these arbitrary numbers. We get emotional, we turn things off, or we heard something in the news, or somebody in our company mentioned something, and for whatever the case might be, we're reacting emotionally. And again, this last point, we view instability as an opportunity and not a threat. This is an opportunity right now in the down economy. CPMs are going to be low. Cost per click prices, the ability to buy media is always cheaper in a down economy, just like with stocks in the stock market. So that is an opportunity for you to get more exposure and get in front of your key accounts or your key ICP, where your competitors might be retracting, you can expand. Now, when it comes to thinking like an investor and then executing like a scientist, scientists, they formulate hypotheses. They tell themselves, if we do this experiment, then we think this thing will happen as measured by XYZ. We don't think like this most of the time when it comes to experimentation. We just kind of approach it, loosely, and we just run campaigns, and we don't really understand what are we trying to solve for. Scientists view failure as learning. You have to give yourself time to really make your paid media campaigns work. I always say to customers, give it at least 90 days, one full quarter, to really measure success with your campaigns, because especially if you have a longer sales cycle, you're not going to be creating opportunities really quickly, and those opportunities are not going to be closing into revenue within the same month. So you need to give it more time. And based on what happens, you want to view that failure as learning. It's a really good acronym. That FAIL stands for first attempt in learning. So always keep that in mind. They analyze feedback and data. Looking at the data, let the data be your guide. Don't, again, use your emotions. You want to make sure that you're looking at the data, you're understanding the trends, and you're making the necessary adjustments. And you want to perform your experiments in a controlled manner. You want to give it a start and end date. You want to know what is your baseline you're comparing against. Meaning, if before your best, let's just use CPL as a simple example, or cost per opportunity was $1,000. Well, hey, that's our baseline that we need to beat against. Here's our budget, here's our time frame. And even better, if you have some sort of auto pause rules that allow you to stay on top of that, or at the very minimum, you set a Google Calendar reminder for you to check your experiments to make sure that they're tracking properly. You have to give your campaigns attention. And then finally is course correcting based on the results. Don't be afraid to change. Don't be tied to your ideas and your experiments. If something doesn't work, it's okay to move on. You learn from it. That doesn't mean you're a failure. It was just your first attempt at learning. So remember, when it comes to paid experimentation, what really separates the top advertisers from the worst advertisers is the top advertisers are investors. They're thinking like investors, they're executing like scientists. And when it comes to paid experimentation, remember, you are investing, you are not gambling. So if you don't understand your numbers, you don't have your outcomes in mind, all these different things we talked about, then you're gambling and you're just throwing your money out there. And you can't afford that in a down economy. You need to make sure that every dollar is working for you. So with that being said, let's talk about responding to budget cuts. Some of you, your budgets have been cut as high as 70%, others not so much. But if you have been impacted in budget cuts, let's talk through some practical steps you can take. So step one is you want to find the bloat. Now, the bloat is what I call inefficient spend. So what is those inefficient spend? Where are you spending in the most optimal way? So as we have a tendency to grow in the hypergrowth startups, we get careless. We let campaigns run for too long. They're not really producing impact to revenue. We are investing in a bunch of different tech, and our tech stack is massive, but the actual value is not there. Maybe we're only using certain tools for like one specific feature, and we're overpaying for everything. We have certain agencies or contractors or even internal team members that are not pulling their weight, and they're not really helping us drive a meaningful difference. You want to look at all those different things and assess its impact towards revenue and ask yourself the hard question: can we live without insert campaign, technology, or headcount? And those tough decisions will have to be made, but this is one way for you to really course correct and adjust so you can see, hey, because the definition of insanity is doing the same thing, expecting a different result. You can't keep operating the same way. Every dollar is on the line. So look at your campaigns, your headcount, your technology, and if it's not driving a meaningful difference, you need to cut that. And you can free up that additional budget. So maybe you had 30K in inefficient spend that now you just freed up, which will help you offset your budget reduction. Step two is to adjust your strategy. Now, because you have less budget, that means usually you have reduced coverage. So for example, instead of covering all product lines, can you focus on the top two? Instead of covering and targeting 1,500 accounts, can you focus on your top 50 most ideal accounts that if they close, the average deal size is massive, the win rates are greater, it's the industries that you can support the best. And then, of course, instead of covering 6 industries, can you focus on one? So you really want to narrow your scope here because you don't have as much budget. So you need to make sure that every dollar you spend is stretched in the most meaningful and impactful way possible. So you really want to be thinking here, where can we be a big fish in a small pond? And this way, let's say if you only have $10,000, but your audience is only an audience size of 5,000, you're going to be massive to those 5,000 people in terms of saturating that audience and getting them to know you and really understand that you are a potential solution. Versus if you have $10,000 and you're trying to get in front of an audience size of 1 million, you know, that those folks are never really going to know you. Your frequency is going to be really low and your actual impact is going to be negligible. So with that, you need to adjust your strategy. And the easiest way to do this is to really do an analysis. What are the opportunities? What are the trends that you're noticing in terms of industries, accounts, and where can you narrow that focus and that scope to that segment that you can best serve and that is also the most impactful for your business. Step 3 is to plug your holes. The time for flying blind is over. Every dollar is on the line now. You have to make sure you have the proper reporting, tracking, alerts. Again, you're investing, you're not gambling. If you're flying blind, if it takes you 6 Salesforce reports and 30 minutes to answer basic questions like, hey, what was my average cost per opportunity this month versus last month? That's a problem. And you can't be dealing with that in down times. You need to know your numbers. And if you operate this way in the good times, when the down times come, you will not be surprised. You will not be shocked because you'll understand your efficiency metrics and you'll be able to course correct and go on the offense where everyone else is on defense. You can go on the offense and take that additional market share out there at a reduced cost because media cost is so much cheaper during down times. And then step 4 is you want to schedule a weekly war room. This is just a cool way of saying a weekly video meeting, a Zoom meeting, a Google Hangouts, whatever you're using. But business is a team sport and you need all players in the game. So you are creating campaigns, you're trying to drive meaningful business outcomes. Usually you're not doing that in a silo. You need to collaborate with sales. You need to collaborate with products, CS, whoever needs to be there. You want to make sure you have all relevant stakeholders in that weekly meeting where you can be discussing, hey guys, what are the new ideas, things that we haven't thought about, things, channels that we haven't tapped into that where we can spend less budget, but drive more meaningful impact in terms of revenue. And then what are our progress against the KPIs? We need to do that every single week. How are we tracking in terms of conversion rates and cost? What is our efficiency looking like? And then what are our current challenges and blockers? How are we doing in terms of what we're coming up against? How can we overcome that? This weekly meeting and that weekly sync is going to be massive to make sure that you respond to these budget cuts and you come out ahead. Now let's talk about building your strategy. When it comes to building your strategy, typical planning looks like this. So we start with tofu, mofu, bofu. So top of funnel, middle funnel, bottom of funnel. Now there's nothing wrong with this and it applies to literally every business on the face of the earth. But the challenge is it's a little bit broad. So a framework that I like to adopt is called the 5 stages. And it allows me to be a little bit more specific on what are the key stages that I'm focusing on and the outcomes that I want to drive from those stages. So let me show you an example. The 5 stages are create, capture, revive, accelerate, and expand. So if you were just thinking about things in terms of tofu, mofu, bofu, you might forget about revival or acceleration or expansion. These are all other key areas that marketing and your paid campaigns can make a meaningful difference. So by breaking it out into 5 stages like this, it'll allow you to really hone in on what key stage is going to have the most meaningful impact for you. And then you can start to think through the channels, the budget, the targeting, the exclusions, and all of the different ingredients required to be effective in that stage. So when it comes to create, this is where you're going to try to build brand affinity and trust, right? Ideally, you want to create raving fans. This is demand creation. You want people to know, like, and trust you and understand and create desire and interest for your product or category. When it comes to capture, this is where you're trying to convert those in-market buyers who already have interest. They know they have a problem. They're looking for the solution, and you need to make sure you're showing up and you are the most optimal in terms of your competition so you can win that deal. Revival is all about restarting closed loss opportunities. So deals that were once active that you lost, maybe it's because of timing or competitors, whatever the case might be. How can we tap into that? Like that's super low hanging fruit that we can tap into to try to get those deals back because they already know us to a certain extent versus just trying to reach somebody brand new that's never heard of us before with Create. Acceleration is all about how can you move those deals faster. So if you have, let's say, 30 deals in pipeline right now, how can you help sales and be a good team member to move those deals faster and support them in whatever way possible? That's massive. If you can get 3 more deals to close versus not having those deals closed and you can get them closed in a faster time frame, that could be the difference to offset all your budget cuts and all these things and be able to hit your goals. And then finally is expansion. How can we drive more revenue from existing customers? It is infinitely harder to drive to acquire a new customer than it is to drive revenue from an existing customer. That's also a key area that you could potentially focus on to be able to offset this times in the down economy. So when it comes to deciding on where you should start, this is very case by case basis. Different companies have different goals in mind. But the key thing I want to highlight here is the budget to ROI ratio in terms of the different stages. So I usually recommend clients start from the bottom and they work their way up. Now, I understand most SaaS companies are focusing on driving net new acquisition with their paid dollars. So for you, that'll probably be something like acceleration and then onwards and not expansion. But what I really want to highlight here is for you to get in front of 50 opportunities with something like LinkedIn ads, the budget required is dramatically smaller than trying to drive and create demand for an entire category of people who don't know about you or don't even know they have a problem. So in terms of if you need to satisfy the needs of today, you have to drive pipeline today. you're going to really want to focus on working from the bottom and then going up. Now, the challenge is there's only so many deals in your pipeline that need help to be accelerated. There's only so many deals that you lost that you can try to get back. And there's only so many people in market that know they have a problem that are looking for a solution. And this is also the most competitive and expensive. So you do want to move towards creation and creating demand as soon as possible, because if you can build that brand, it'll give you this moat that in bad times you are less reliant on paid dollars because you're just driving more direct and brand and referral traffic to your website, not needing your ads. So the sooner you can get to demand creation, the better you'll be in the long term. But in the short term, if you need to drive revenue today, you should probably focus on these bottom of funnel stages first and free up budget to start investing in demand creation as soon as possible. So let's go ahead and give you some different ideas of tactics for each stage to really illustrate this further, because based on the stage, the tactic, the KPI, and the outcome will change. So moving on to create. Again, brand affinity and trust, raving fans. So the strategy here might be to create genuinely helpful content with no ask. And the tactic would be to distribute this content in feed via channels where your ICP hangs in. So for us at Metadata, that's Facebook and LinkedIn as an example. But for you, maybe that's Reddit and running Reddit ads and distributing content there, or maybe it's Twitter, etc. It depends on where your customer is. And then the KPIs might look like something like, blended cost per opportunity for both organic and paid, as we're not going to get direct attribution. Cost per consumption. Are people consuming our content? Are they liking our content, right? The more they like our content, the more we educate them on their problems and our brand, the more likely we are to create that affinity, that trust, and those raving fans. The second one is capture. So again, we're trying to convert interest from in-market buyers here. So a strategy being, can we leverage audiences and channels with existing intent? So bidding on high intent keywords on Google. So people searching for software, searching for your category, they know they have a problem. Bidding on paid listing sites like Capterra or Software Advice, or doing remarketing campaigns. People who've already been to your website, they've consumed your content. Can you get in front of those individuals? In terms of KPIs, this might look like your pipe to spend ratio, your direct cost per opportunity, and your return on investment. For revival, we're trying to restart closed lost opportunities. So in terms of your strategy here, it might be to create personalized experience to revive these ops, reaching out to these individuals, trying to get them into customer events, maybe doing direct mail, in-mail, whether that's in-mail or LinkedIn conversation ads. And you're trying to get in front of these folks and make them feel special and try to get that deal back on the table. In terms of KPIs, ops created, blended cost per op. KPIs will differ for you and each and every company. These are just examples just to really get your mind thinking. Fourth is outcome of around moving deals faster for acceleration. So can we help be a good partner to sales? Can we share social proof? Can we answer objections preemptively? Can we invite these customers to events or dinners? Can we show in-feed ads through like LinkedIn and Facebook that will make our potential prospect and potential customer understand that our business is a no-brainer, our solution is a no-brainer? So can we do that, right? And then can we look at things like average time to close? Here are all just different ideas. There's a million different strategies and tactics in terms of how people approach these different stages. But by segmenting it this way, you can start to think critically about how to improve that outcome. And then fifth, but not least, is expansion, driving more revenue from existing customers. So for example, can we invite folks to events or dinners? Can we run one-to-one campaigns on LinkedIn targeting specific companies, or one-to-few campaigns targeting specific companies? Can we try to get into, if you're reaching franchises, can you try to reach other similar franchises in other parts of the country that you haven't created as a customer? Can you leverage a customer to give you a referral? All these different things that can go into expansion. So just to put it all together, because we covered a lot here, let's say we had a 100K budget and we wanted to do a full funnel strategy. You can use this as a template, but essentially you would map out the different stages here on the left, your budget, the channels that you feel will best support you for driving that stage, the targeting. So what audiences are you going to leverage? And then your exclusions are very important as well. So by creating and mapping out these different stages, we can then map out our exclusion audiences so that we can move people through this full funnel process. So for example, for demand creation, we have 40K allocated here. We want to be aggressive, try to drive demand. And then for capture, we have 40K allocated. So for example, we're driving people through Facebook, LinkedIn, and YouTube. We're getting in front of our key accounts. And then on capture, we're retargeting individuals that have consumed our content through demand creation. And we're showing them more content, more offers, trying to get them to raise their hand. We're bidding on non-branded search terms. We're bidding on things like Capterra, where people already are showing interest and intent, and we're showing up there. For revival, we're targeting closed lost opportunities. We're trying to get those folks back. We might be doing something with like Facebook or LinkedIn ads, display ads, getting in front of those ops. For acceleration, we could be doing things like gifting as a channel, trying to accelerate sending those folks like Starbucks gift cards or things like that. Custom swag, whatever we can do to try to accelerate and create a positive experience. And then expansion, we're inviting people to events, etc. So this is kind of putting it all together. You don't have to hit all 5 stages at once. It's going to vary based on your budget and your needs. If you're just starting out, again, remember to think about this. And if you're trying to focus on net new, start with capture, and ultimately all companies should get to create, but you need to be mindful of where you are in your situation. So I hope this presentation was helpful. If you have any questions whatsoever, please reach out to me on LinkedIn. I'll be more than happy to help you out, and I'll see you in demand and seeing all the other presentations.